Hi, in this video I'm going to talk about IAS 40 investment property. So I'm going to discuss in detail how investment properties are accounted for. For example, what is their initial measurement, subsequent measurement, how they are disclosed in the financial statement, what is the accounting for investment property, so on and so forth. Hi, if you're new to my channel, I'm the commerce specialist. I create videos covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. So let's jump into IAS 40 investment properties. So first of all, let me give you the definition of investment property as per IAS 40. So investment property is land or building or part of a building or both held by the owner or the lessee as a right of use asset to earn rentals or for capital appreciation purposes or for both. You need to understand that the recognition criteria is very important. If you have a building, for example, and you're using it as your office, which means this is an owner occupied building. So this building should be treated as a non-current asset and should be accounted for as per the provision of IAS 16 property, plant and equipment. If you have building or any property which you deal in, for example, you are a real estate broker, you buy and sell properties. In that case, these properties, these buildings will be taken as inventory and will be accounted for as per the provision of IAS 2 inventories. But here we are talking about it's a property, let's say a land or a building or both, held by the owner, not for use, not for sale, but for the sheer purpose of either rentals or capital appreciation, or it could be both. Only and only then this property will be recognized as an investment property and will be accounted for as per provisions of IAS 40. In other words, you can say that if you have property which is in use for production and supply of goods and services or for administration purposes, means you have your office in that property, that would be taken care of by IAS 16, property, plant and equipment. If your property is for sale in normal course of business, means it is your inventory, then it will be taken care of by IAS 2 inventories. So let's talk about the recognition criteria of investment property. As per IAS 40, a property should only be recognized as investment property only and only if it is probable that the future economic benefits relating to the investment property will flow to the entity and the cost of the investment property to the entity can be measured reliably. So if these two criteria are met, only then we recognize a property as an investment property. So once we have recognized a property as investment property, let's talk about the initial measurement. The initial measurement of investment property is usually by its purchase cost, means the purchase price plus directly attributable expenses and costs. For example, transaction costs, legal fees, taxes, professional fees, so on and so forth. For self-constructed property, the cost is equal to the cost at the date at which development and construction of the property is complete. The next thing you need to know is the subsequent measurement. Okay, you have an investment property, you measured it initially at cost. Later on, what happened? Later on, you have two options. For subsequent measurement, it's either measured at cost model. The cost model as per IAS 16 is that you record your investment property at historical cost, less accumulated depreciation and impairment cost, and show the carrying value in your statement of financial position. Alternatively, you can use the fair value model. When you use the fair value model, the investment property is measured at fair value at the end of the reporting period. And obviously, when you record it at fair value, there could be a gain or loss. Please remember, once a property is classified as an investment property, it is not subject to depreciation, which means once you recognize a property as investment property, it is not depreciated further. As compared to IAS 16, if you are recording it through cost model, yes, it is depreciated. So it is up to the discretion of the organization whether they want to use cost model or fair value model, but please note whichever model is chosen, it is to be applied on all the investment property. You cannot pick and choose. Here's something very important to note is that when you're using cost model as per IAS 16, if there is a gain on revaluation, that goes into revaluation surplus account. But in fair value model, if there is a gain or loss, whatever it is transferred to profit and loss account. Now, to have a good understanding of application of IAS 40 investment property, I have these two questions which we will discuss, and you will understand the application of IAS 40 investment property. So here in question number 1, it says, on 1st October 2029, Delta Company had the following investment properties. It uses fair value to measure investment property. IP is investment property. So the first property is Bahria Town, which cost 150,000 on 1st October 2024. The property is a freehold and is rented for 6 months. Current fair value of property is 175,000. And the other property, we'll talk about it, but the requirement is what is the carrying value of each property in the statement of financial position on 1st October 2029. So I'm talking about Bahria Town. Okay, Bahria Town, which is BT. Since it's an investment property, it should be treated as per IAS 40. And obviously, if it has been rented, so whatever is the rental income, that has to be transferred to profit and loss account. At reporting period means at year end. Because we are using fair value, the cost was 150, the fair value is 175. So the difference between cost and fair value is 25,000. This should be transferred also to profit and loss as per IAS 40. Which means at the reporting period in the statement of financial position, your investment property will reflect, the value of 175 in the statement of financial position, and the gain and the difference between cost and the fair value will be transferred to profit and loss. Any rental income earned from this property during the current period will also be transferred to profit and loss account. Obviously, it's an investment property. We are not calculating depreciation on it because it is held for rental purposes. So any rent comes in will be taken into profit and loss account. And because we are using fair value, so okay, so at the end of the year, we compare the cost with the fair value. If the fair value is high, there is gain, and any gain is transferred to profit and loss account. Now let's talk about the other property. The other property is Alaska Town, which costs $75,000. This is used by Delta Company as its head office, means it is owner occupied. This building was purchased on 1st October 2019. Current fair value is 120,000. Delta Company depreciates building by 2% per annum on cost. What is the carrying value of each property? Okay, so let's talk about Delta Company now. So let's talk about Alaska Town now. The cost was 75,000. And this was used by the company as its head office. That means it's owner occupied. The building was purchased on 1st October 2019, and at the moment it is 2029. So it has been 10 years. If it is owners occupied, that would be treated as per IAS 16. That means we have to calculate depreciation on it. 75,000 is the cost of the asset. 2% depreciation we are calculating, which is 1,500. It has been 10 years. So when you multiply by 10, it will give us 15,000. So the historic cost of the asset is 75. Depreciation, accumulated depreciation over 10 years is 15. So when you minus, you get book value of 60,000. This will be shown in the statement of financial position. So let's talk about the second stage. The second stage is there is a possibility of transfers. Transfer from investment property to owner occupied or from owner occupied to investment property. which means there is a possibility that an organization has a building which was used as their office. If it is used as an office, that means it's owner occupied, it is for use in the business, so it will be accounted for under IAS 16 property, plant and equipment. But there is a possibility after a few years, the company vacates the office and holds it as an investment property or maybe rents it out. So if the company is not using the asset and renting it out, that means there is a change of use. So if there is a change of use, that is from owner occupied, now it is solely used for rental purposes, now we have to apply IAS 40 on it, investment property. Or it could be vice versa. The company has a property only for rental or capital appreciation purposes, or for both, and after some time they decided that we are not letting it out any further. Instead, we are going to use this property as our office. Again, there is a change of use. So if there is a change of use, now we have to come back to IAS 16 cost model or revaluation model. So please understand there is a possibility of transfer to or from investment property. So as per IAS 40 investment property, transfer should only be made to or from investment property when there is a change of use. The purpose of holding the property changes. So let's assume an investment property is now becoming an owner occupied property. Let's say if we are talking about an investment property, now it is changed to owner occupied. So from when it was investment property right up till this time, this is called date of change of use. This is change of use. Now it is becoming owner occupied. While it was investment property, it was accounted for under fair value model right up till the date of change. After the date of change, it may be accounted for depending on what you're doing with the property. If it is for sale now, okay, if it is for sale, a regular sale in business, it is treated as inventory, it will be treated as per IAS 2. If it is for use by the company itself, then we are talking about applying IAS 16 property, plant and equipment. But this would only apply from the date of change of use. Right up till the change of use, if you have an investment property, right up till the date of change of use, fair value model is applied. Once you are changing the purpose of holding the asset, then you have to see if you're selling it, it becomes an inventory as per IAS 2. If it is owner occupied, then IAS 16 property, plant and equipment. Here you also need to understand that right up till the date of change, all this, obviously you're using fair value method, which means no depreciation is calculated on the investment property. And if there is any gain or loss, because you're using fair value method, that would be transferred to profit and loss. But from date of change, subsequently, what happens? So from this date onward, when you are changing the purpose of the asset, when the purpose of holding the asset changes, there is a change of use. From investment property, it is, let's say it's coming under IAS 16 because you're using the asset. What happens? Initial measurement will obviously be at the fair value till the date of change. After that, as per IAS 16, you can apply cost or revaluation model. And if you apply that, obviously you will start calculating depreciation. And at the end of the reporting period, obviously if you are applying revaluation model, if there is any gain on revaluation, will go to revaluation surplus. This explanation was from investment property IAS 40 if there is a change of use to IAS 16 property, plant and equipment. What happens if you have a property which was owner occupied and after some time there's a change of use and it becomes an investment property? So what happens? Let's say the property was earlier accounted under IAS 16 property, plant and equipment. So obviously you were calculating depreciation. Okay. At year end, obviously if it was cost or let's say revaluation model, so there was a difference between carrying value and fair value, so there is some, let's say, revaluation surplus. Fine. Now a time comes, this is the date at which there is a change of use. So till the date of change of use, yes, you will calculate depreciation. If there is any difference in carrying value and fair value, it will go to revaluation surplus or otherwise. So from date of change onwards, the property is recognized as investment property, and when it is recognized investment property, it is measured initially as fair value. Okay, and then there is no depreciation calculation. At the end of the reporting period, what happens, the difference between its fair value now and at the end of the reporting period, if there is any gain or loss, that will go to profit and loss account. Now let's talk about question number 2, where your understanding for application of IAS 40 investment property will increase a little further. So in question number 2, it says Bravo LLC rented its building which was used as its head office before. That means this building was an owner occupied building, and now they are transferring it on June 30th 2029 as an investment property because it's being rented. The company used fair value model for investment property. Original cost of the building was January 1st and 2020 and was 250,000, depreciated over 50-year life. On June 30th 29, its fair value is 350, and on December 31st 29, its fair value decreased to 320,000. Show how this building will be accounted for in the financial statements on December 31st 2029. So here you need to understand, because earlier the building was used as head office, which means owner occupied. If it is owner occupied, it would be dealt with IAS 16 property, plant and equipment. So when it was purchased on January 1st 2020. So from January 1st 2020 right up till December 31st 2028, this is 9 years. So if the asset has a 50-year life and the cost was 250,000, 250,000 divided by 50, you get 1 year depreciation, multiplied by 9, you get 9-year depreciation as 45,000. So original cost was 250,000, you minus 9-year depreciation. Because it is transferred on June, so we need another 6 months depreciation, and that would be 250,000 divided by 50 into 6 upon 12. So that should give you 2,500. So this is depreciation till June 30th 2029. So what is the book value? The book value is 202,500. So at the date of change of use, the fair value was 350. So fair value is 350,000. Okay, because you're using revaluation model, so book value and fair value, book value and market value, the difference will go to revaluation surplus. Because up till now, the building has been used for the company, owner occupied. So it's 147,500. Now comes change of use. So now that we have change of use, the building number 1 would be, the property will be classified as an investment property and will be subject to fair value exercises every year. So because at the date of change of use, the fair value was 350,000. So initially it was measured at 350,000 at the date of change of use, which is 30th June. And by December 2029, the fair value was 320,000. So by December 2029, its fair value reduced to 320,000. So this gives you 30,000 loss, and this 30,000 loss will be transferred to profit and loss. Now, one thing you need to understand that this investment property, which is now valued at 320,000 at December 31st, 2029, will not be subject to depreciation any further. Why? Because we are using fair value model. So guys, if you have any queries relating to IAS 40 investment property, leave a comment. I will reply to you. If you are not yet subscribed, please subscribe to my channel. That is one way of showing that you value my work. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you very much for your precious time. Love you all.